I'm going to teach you a simple strategy that will help you stay accountable in your trading. It has an 81% win rate. What most videos teach you is the strategy, but then you get no help after. This channel is dedicated to following the exact strategy you'll learn in this video, and I post daily analysis around it, so you can watch how it actually works in a live market. This strategy is what helped me pass 2 funding challenges, but my problem is that I always strategy hop. So I'm creating this channel to stay accountable in my own trading, and if you want to follow along with the same strategy to keep yourself accountable and actually stick to something, then you can. So let's get into the strategy. So before we get into the model, I'm just going to take you through the backtest data just to show that this strategy does work. I'm not going to get into too much detail with it, but in 2025 it had an 80% win rate, 2024 it had a 60%, and 2023 it had a 50%. But as you can see, I slowly progressed the strategy and made it better after each year. So yeah, 2023 was 50%, 2024 was 60%, and then 2025 was 80%. So this is one strategy. I know it says strategy here, it's got 2, but these are my entry models. So it's 1 strategy, 2 entry models, 3 phases, 1 instrument, and 1 time frame. This is what this strategy is. And we'll get into more detail of all those separate things as we get into it. But this was just to show you that it's been tried and tested and it is a profitable strategy. So that is my backtest data, but now I'm going to show you my live data for this strategy. So here is the live data. We've had a total return of 15% this year. Strike rate is 38.46%, 13 trades, 5 wins, 6 losses. But when you look into the data, you can see that the strategy is profitable. Even with a 38% strike rate, it is still profitable. January made -1%, February 6%, March nothing, April 1%, May 8%, and June 1%. So a bit different from the backtest data at the moment, just because obviously emotions and stuff like that is different in a live market, but we can see that the strategy is still profitable. So that is my backtest data and live data. Let's jump into how the strategy works. So this strategy, we will be trading GER40 and on the 30-minute time frame. And this first section, we're going to be focusing on what phases we are trading. So phase A is a pullback, phase B is a reversal, and phase C is a continuation. And how do we know what phase price is currently in? So on the 30-minute time frame, what you usually do is I zoom right out to see where all the latest breaker structures are. So we have one here. We have one here. And we have one here. So after you have a breaker structure, the theory is that price will then pull back after the breaker structure down into an area of demand in this case, and then continue to take out that previous high. So we will be trading pullbacks after a breaker structure. Then the reversal would be down here. So that's when you immediately buy in the opposite direction to take out this high. And then also once it has a reversal, you'll be trading the continuations within that area as well to take out the most recent high. So I'm not going to overcomplicate this. It's pretty easy to zoom out and just see exactly what phase that price is currently in. So just to recap, going to be trading a pullback after a breaker structure, a reversal when price comes down into lower prices to where it would be most likely to reverse, and then we'll be trading the continuations. So that's it. Pretty simple. You just zoom out, find out where the breaker structures are, and you can see exactly where price currently is. So now you know what phases we're going to be trading. Now it's time to get into the actual model. Like, what do you want to see in those phases? And this is a mechanical trading strategy, so it's very strict in what you need to see to actually trade. So the first thing you want to see is an untapped demand zone. So also in this example, it's the pullback phase. We've had this breaker structure, so now we are looking to trade that pullback down into these areas down here. So once we get that initial breaker structure, we're looking for the pullback. And then what you want to find is you want to find untapped, in this case, because we're going to be selling, it will be untapped supply zones. And an untapped supply zone is literally an untapped supply zone. Nothing has tapped that area. What we're using is session liquidity to identify these areas. So you can see I've got these session boxes here. So Tokyo session, London and New York. what you want to do is you want to go into indicators and you want to get the trading view trading sessions indicator. So here it is here, just copy this exactly. So you can pause the video and just copy what it says here. So what this does is it marks out the high and the low of that recent session. And to make this easier to identify where you want to trade, we have an untapped supply. You literally just want to see gaps before the supply or demand zone. So in this example, it is supply, and you want to see a session gap and then the supply zone. So an untapped demand zone, then you want to see your sessions indicator before that supply zone. And this is the liquidity we're using. The liquidity is our sessions high and low. Once you've identified the phase, once you've found your untapped zone and you have session liquidity before that zone, you then want to wait for price to mitigate that zone. And there are two entry models that I use. So we have LC1 and LC2. We have to wait for price to also mitigate the area. So the difference between LC1 and LC2 is that LC1, the candle doesn't close in the zone, and LC2, the candle does close in the zone. And if one of them two things happens, you actually enter the market differently. So with an LC1, if the candle rejects the area and then closes in the direction we want to trade, then we just, once that candle closes in that direction, we just market execution straight away and enter. So my bearish candles are blue, so I'm looking for a bearish candle now to close, and then I can enter the market. So that is our entry candle right there. Will be market execution, so you'd enter as soon as the candle closes. You then want to cover the biggest candle next to it, and it's pretty straightforward. This wick here, that's the biggest candle. You just put your stop loss just above that. And then targets, there are different targets that we can aim for, and that's because you have the breaker structure. You basically want to find this model in these areas here. So price could reverse here. We have liquidity here, liquidity just before that area. Price could, so that's already, and this is how it's very easy to find areas. This area is already tapped, so it wouldn't be looking there. The next area is all the way down here. It's very easy to find these areas. Here's the demand zone. Liquidity is just here. So in this case, I would just aim for the first demand, and it's a 1 to 11 to that area. I wouldn't usually actually go bigger than a 1 to 10. So let's just put it as 1 to 10. And there we go. So that was an example of an LC1 in a pullback. And just to recap, you want an untapped supply zone. You want liquidity just before that POI. Price then mitigates the area. You even want to know if you're trading LC1 and LC2, and that's if price closes in the zone or doesn't. This rejected it completely. You wait for a candle closure in the direction you want to trade, and then you market execution. You'll target your reversal POIs as a target. Whatever phase you're in, you'll target the next phase. That's an easy way to remember it. So your targets are, you're targeting the next phase. So now let's do the second entry model in a different phase. So now we're going to look at a reversal trade with LC2 entry model. So let's just recap quickly. We have our breaker structure here. We then get our pullback. We would be trading the pullback into reversal areas. You would then find where you would want to reverse from. So in this case, we have this untapped demand zone right here. And then you have liquidity right here. So your session boxes, the lows just above your demand is where you'd be looking to trade from. So we need to wait for price to obviously mitigate this area. So I also didn't mention the strategy times. I trade 8 a.m. to 5 p.m. and that is London and New York session. Never after 5:30. My last entry would always be at 5:30 if there was one. But so this is a situation where price has mitigated the area outside of the hours. So you'd just be waiting for the 8 o'clock candle to see what happens. So price mitigated this area at about 3 a.m. And then you would wait until, this happens very rarely, but it's a good area to take a trade from because it's at a high probability area for a reversal. So we'll get to the 8 o'clock candle. So the 8 o'clock candle, it says 7:30, but it would have closed at 8. And this is an example of LC2. What usually would happen is, obviously, if it was in session, it would come in, the first candle would close in it, and then we'd get our entry. But because we've had all this price action here, we can still get into it. So our liquidity for this area is obviously this low right here. So price swept that liquidity. We come into here. We then have price then created another section of liquidity, which was the Tokyo session liquidity. So price then swept these lows. Price then, the candle closed literally inside it. So it's pretty simple to identify if a candle closes in the zone, because these candles you can see haven't closed in the zone, and this candle has closed in the zone. So when you get this example, when price closes in the zone, we'd class this as the liquidation candle. So that's where the LC comes in to the entry model. So liquidation candle. So we had this liquidation candle, and this is how you would enter. You would enter from the lowest candle in that demand zone, which is the one that closed in it, and you would set a pending order at the top of that candle. So because this is a reversal, we would be, in this case, aiming for this high right here. Once price closed here, you would have set a pending order to trigger at the top of that liquidation candle. And your target for a reversal is a bit different to a pullback. It would be the next high. So if we're looking at this structure overall, the next high is all the way over here, but I don't really be holding a trade for that long. You can target that high, but I would be targeting this high because this is the most recent next high, and we've probably got good risk to reward on it anyway. So yeah, I'll just go to 1 to 5 just to keep it good. So let's quickly just recap that. So we had our breaker structure, then we had the pullback, so you'd be trading the pullback. You would then be looking for the reversal. So we have our untapped demand zone right here. We have a liquidity sessions just above it. As it's an LC2, the candle closes inside the POI. We then set a pending order at the top of the liquidation candle, and then it would trigger once price goes past that candle. So that is the strategy. So we went through the 2 entry models, how to identify the model, and we went through the phases. So now we're going to be getting into what makes a POI invalid. The only thing that makes a POI invalid is if it's already tapped. And here's a trade here that I took. This was LC1. This was actually a tap zone. So if you look at it, it looks like an untapped zone. But you see this blue candle here, it tapped the zone. That's actually a demand candle that tapped the zone as it was creating it. So this was untapped. I ended up taking the trade anyway. But if this candle was black, then it will be classed as untapped. But because it's a blue candle, within this, it's classed as tapped. And then should you take LC1 and LC2 together? So if you get an LC1 entry and it fails, do you then take the LC2? I wouldn't do that. You're either going to get an LC1 entry or an LC2. I wouldn't start doing LC1 and it fails and I get stopped out. I then wouldn't be looking for an LC2. I would just leave that trade. That's that. For an LC2 to become invalid, we have a trade here. We have our untapped demand zone here, our liquidity here. Price then comes into the POI. It closes inside, so we know we are going to be trading an LC2. We want to mark the liquidation candle for entry. It would obviously be a pending order. Price then doesn't trigger and it pushes down further. So what you would do in this situation is you'll keep moving the entry down to the next candle. When it becomes invalid is when the candle closes beneath the POI, and then that means that POI has failed. So that is an LC2 failed entry. It also can happen with LC1. What LC1 is going to do is going to reject, close, won't give you an entry, and then it will just push straight for it. But the entry becomes invalid if the candle closes below the POI. What can happen sometimes is the POI will get swept and it will sweep the demand liquidity, and then it will give you an entry and it's still active. But if it closes below it, then it's invalid. Other things that make a trade invalid is news, and I would just not trade if I get an entry before NFP and CPI. That's it. With Germany 40, that's the only ones that I'm not trading. I can trade everything else. So like I said, there's probably other questions you have and you can comment on this video. But for me to answer those questions, You can watch the daily analysis videos and you can comment on that. And then in the next daily analysis video, I can answer your questions. So that is the strategy. If you want to follow this strategy live, that's exactly what my daily analysis videos are for. I break it down in real market conditions every single day. So new videos go up at 8 a.m. So if you want to follow along, make sure you're subscribed and have the notification bell turned on so you don't miss one.